Vikas, market breadth is as tempered as it could be today. We've had a lot of global indicators that are weighing on the market right now. Give us a sense of what you're making of the market texture today in light of everything that has happened back home as well as globally, and especially the tensions that are seen to be deteriorating further in the Middle East.
I think the what is happening in the Middle East is slightly worrying. That Israel attacking Iran could remain either prolonged and it could escalate. Obviously, we need to see how much it escalates. We will have no answers immediately. Having said that, historically these kind of conflicts were very, very relevant for markets because they had a huge impact on the oil prices because it was controlled by OPEC, which we have seen because of post-Ukraine war, because of the multiple sources of supply, that has kind of got diversified. Hence, you don't see a runaway impact on the oil price. Of course, oil prices might harden, in a shorter term because a particular country's supply can be in question. To that extent, we will have to see what impact comes. But I don't think right now it looks like a very alarming situation. But you never know. These are the things which you can never predict, you can never plan. You can just be prepared for it. As far as the markets are concerned, I think we had a lot of global uncertain environment in terms of tariffs, news around tariffs, whether it is about India or vis-a-vis China. But at the same time, we had a lot of good positive news as far as the domestic economy is concerned, whether it is our tax collections to RBI's solid action to boost economy in last 6 months, including the last policy. So I think as far as the way I see is that there are a lot of positives happening domestically in an otherwise global uncertain environment. Markets having recovered from the recent lows might find a little bit of consolidation phase or a correction phase. I do not see any reason for a steep correction or a steep fall, but you never know. These are the things short term. Calling out any short term movements of the market is futile. According to me, the way I think is that India's story remains intact, and the earnings growth in India this year will be very robust, thanks to the solid action by the RBI in bringing the interest rates down, inflation being down, and I think credit growth picking up. So net, from a medium to long term perspective, any correction coming would be an opportunity. I don't see major risk, but short term is very hard to call out.
Absolutely, and I think time has told us, or rather history has told us, that markets eventually do climb the wall of worry. But Vikas, like you said, it couldn't get any better for India, right? You've got a bazooka coming in from the RBI, you've got an above normal monsoon and an early arrival of monsoon at that. Inflation seems to be under control. The economy is holding up well. At an index level, do you think all the best is priced in for now at least?
It looks like that, a lot of good news is in price from a short-term perspective. I said, again, it depends on your horizon. If you think 1 year, 2 year, 3 year, it is not priced in. But if you know next 1 to 3 months, I guess it is priced in. So that's the reason I said that market probably might consolidate here for some time. And if news develops probably a little negative, then it can also correct a little bit. So these are the normal part of the market, journey. And, we don't pay too much attention from a short-term perspective, to be honest.
Hi Vikas, morning. This is Shrishti also joining in. And Vikas, time and again you have debated about the premium valuations that Indian markets do hold. But with the recent move of 50 basis point of cut, Vikas, in the rate cuts, this will definitely translate into higher valuations if somebody takes the hat of the DCF and look at from the DCF lens. Give us some sense that in which sectors you believe that the valuation reset can happen the most?
As far as the interest rates are concerned, when the discounting rate comes down, it applies to all sectors, of course, depending on the capital efficiency and a lot of other assumptions on the growth. Impact on each sector, could be different, but in general, the overall equity valuations do tend to go up. Like we recently wrote a note also around it, and where we said that, very often we don't understand the implication of interest rate cut in discounting rate very easily, as much as we understand in a asset class with the predicted cash flows. Equity is slightly more complex in that sense. But as a rule of thumb, even if you say a 2% drop in the interest rates, which is a 2% drop in the discounting rate, which is a function of risk-free rate and risk premium, in India's case, both are coming down because of um, structural repair India has gone through. And because of that, we are seeing, valuations are going to get lifted and they are kind of premium. A 2% drop in the interest rates, everything else remaining same, increases the equity valuation in and around 35%. So I think that we will see in times to come, because, in a pessimist time, people don't believe growth assumptions. In optimist time, people do overbelieve the growth assumptions. I do believe right now there's a lot of skepticism around India's earning growth this year, like we saw in Q4 of last year. But I think we will see earnings upgrade. I don't see too much pessimism around the earnings in India. And as those numbers come by quarter after quarter, you will see India getting re-rated.
Okay. So, Vikas, putting the short-term view, like you said, behind us, what should be the ideal portfolio construct right now? What should be the sectoral or a market cap flavor that one's portfolio should have if you're looking at the next 2 to 3 years?
Yeah, I mean, look, again, you don't change every day your portfolio construct. India, as I've said repeatedly, India remains one of the most promising market around the globe, and your portfolio should, reflect that 5-10 year view rather than even short-term view. And we don't make any tactical assumptions. So from that standpoint of view, banking, financial services, of course, continues to remain very large sort of exposure for us, specifically in the current context where the interest rates are coming down. So last sort of 6-8 months, we've been very, very bullish. Secondly, manufacturing is something which is a very, very big trend, which is going to be here for some time. A lot of opportunities are coming about. Within that, of course, there are a lot of intermittent, trends, because manufacturing is a very wide subject, between specialty chemicals to auto components to pharmaceuticals to, footwear manufacturing, garment manufacturing, EMS, defense, capital goods. It's very wide, so you can play within those things. But generally speaking, the tailwind is in the favor. And I mean, we think recently chemicals are kind of, coming back in an interesting spot. We've been owning a lot of CDMO. So I think the manufacturing as a basket is a very, very promising basket, I would say, to remain there. And the third bucket where, generally speaking, little less choices are available, but still you do have choices available, which is, in the consumption basket, across the board. And, you good to look at between discretionary and non-discretionary. So if you allocate your capital around these three broad buckets, of course, sectorally is only one part. You have to identify right set of companies. I think you should be by and large coming, out well in this journey.
So that's the take on the outlook going ahead. But Vikas, you mentioned chemicals. So on that note, I want to also ask you about some other crude sensitives, the likes of your refiners or your OMCs. Other than that, aviation stocks, tires, paints. Since you've mentioned chemical, would this spike up in crude and the following dip in some of these sectors make these sectors attractive to buy now for the long term?
Look, again, we have not seen, this is not the first time we have seen crude price up and going up and down. So if because of this short-term movement, if you get a company which you like at an attractive valuation, surely, there's a case to be looked at. And that again varies between company to company. It's very difficult to call out, a particular sector, because within the sector also companies have different sensitivities. And hence one has to be very careful about looking some of these things. But yeah, every time crude price spikes up and there is a worry about margin squeeze and all from short-term perspective, they always tend to kind of done well. For example, I think Pidilite, whenever stock price goes up, oil price goes up, stock comes down, but I think those are generally good. Of course, like this, every stocks have its own nuances and one has to kind of know a lot more detail around each of them.
All right, Vikas, give us some more sense on what exactly are you liking within the auto ancillary pack, because the most that we hear is on the export opportunity that lies ahead for these companies, and also some companies are transitioning into some of the other segments like aero defense. So any particular segment of liking within auto ancillary, or do you like some of these diversified plays?
Again, auto ancillary is a very common this thing, and I can only say the basket, but each company has a very different business model that one has to study. I mean, we own, a few names like Endurance, ASK Auto, which we like because in general, we are positive in the auto space, but in particular, we have studied those individual companies and we find this covered in place. So I think, according to me, it is about understanding those spaces, companies which have not much skewed exposure towards only ICE. So you should take into account when you look at a company that what is the exposure towards the transitioning, what is the exposure towards the diversity of the market, what is the exposure towards import versus export. So I think all those things have to be taken into account, and each of the segment also has their own margin profile and capital intensity. All of them have to be kind of looked at before investing.
Absolutely, they do. But Vikas, thank you so much for your time today. Good to get in your thoughts.
It was good to chat with you. Thank you.
Okay, let's move on and let's just address what's happening in the market. You've seen a little bit of a rebound, if you will, from the lows, and just about